Imagine waking up tomorrow to discover that someone quietly took 5% of everything in your bank account overnight. No warning, no notification, no dramatic headline. Just less. People would call it theft. Politicians would face outrage. Financial markets would panic. But here's the uncomfortable part. Something remarkably similar happens every single year, only it doesn't happen with a line item on your bank statement. It happens silently, legally, and most people thank the system while it's happening. The strange thing is that this invisible tax doesn't require Parliament to vote on it every year. It doesn't arrive in the mail. You never sign a form agreeing to pay it, yet almost everyone does. If you've ever wondered why earning more money somehow doesn't feel like becoming richer, why your savings account keeps growing while your purchasing power doesn't, why prices seem to rise faster than your financial life, then you're already living inside this story, and the tax collector isn't who you probably think it is. To understand what's happening, we have to start with a simple question. What does it actually mean to save money? Most people imagine saving as freezing today's purchasing power for tomorrow. You work, you earn. You don't spend everything. The leftover money becomes a bridge between your present and your future. It feels logical. If you save $10,000 today, that $10,000 should represent roughly the same amount of real value years from now. Maybe not exactly, but close. Unfortunately, that's not how modern money works. Because the number printed on your account isn't the same thing as purchasing power. Those two ideas quietly drift apart over time, and that tiny gap becomes one of the largest wealth transfers in modern history. Let's imagine two neighbors. Sarah spends every paycheck. David saves 20% of everything he earns. 5 years later, David feels responsible. His account balance has grown. He opens his banking app. The numbers look bigger. Mission accomplished. Except he decides to buy a house, or pay for university, or simply fill his grocery cart. Suddenly, those bigger numbers don't stretch as far as they once did. Nothing disappeared from his account, but something disappeared from its value. That's the invisible tax, not a reduction in dollars, a reduction in what those dollars can actually buy. Economists call this inflation. Most people think they understand inflation. Prices go up. End of story. But that's only the visible symptom. The real mechanism is far more interesting. Imagine an island with 100 people. Together, they produce 100 loaves of bread every day. There are $100 circulating on the island. $1 buys one loaf. Simple. Now imagine someone magically creates another $100 overnight. Has the island produced more bread? No. Has anyone become more productive? No. There are still only 100 loaves. But now there are $200 chasing them. Prices begin adjusting, not because bread became better, because money became more common. Eventually, each loaf costs around $2. Nobody announced a tax. Nobody confiscated anyone's cash. Yet anyone holding dollars suddenly owns a smaller share of the island's production. That's the invisible tax. Money didn't lose digits. It lost purchasing power. Now here's where reality becomes more complicated. Modern economies aren't tiny islands. They're enormous networks filled with businesses, technology, international trade, productivity gains, debt, and expectations. Money creation doesn't instantly double prices. Sometimes it barely moves them. Sometimes it takes years. Sometimes innovation offsets part of the effect. But over long periods, the pattern becomes remarkably consistent. Currencies slowly buy less. A cup of coffee that cost 50 cents decades ago now costs several dollars. A family home that once seemed affordable now requires decades of income. Healthcare, education, insurance, groceries. The list keeps growing. People often blame companies, or politicians, or supply chains. Sometimes those explanations are correct. Sometimes they're not. Inflation has many causes: energy shortages, wars, natural disasters, trade disruptions, changing consumer demand, higher wages, government policy, central bank decisions. No single factor explains every increase in prices, but regardless of the cause, the result feels identical to households. Your money buys less. Which brings us to the uncomfortable question: why would any society tolerate this because inflation isn't purely an accident? A world with absolutely zero inflation sounds attractive, until you see its trade-offs. Imagine businesses expecting prices to fall every year. Consumers delay purchases. Companies earn less. Investment slows. Hiring weakens. Debt becomes harder to repay because yesterday's loan must be repaid with tomorrow's more valuable money. Economic activity can freeze. Many central banks therefore aim for low, positive inflation instead of zero inflation. The idea is that a small, predictable decline in purchasing power encourages spending, investment, and economic flexibility. Whether they've succeeded is a matter of constant debate, but that's the official reasoning. The challenge is that small compounds. 2% sounds harmless, until time enters the conversation. Suppose inflation averages 2% every year. After 1 year, you barely notice. After 5 years, things feel slightly more expensive. After 10 years, your money buys noticeably less. After 20 years, the difference becomes dramatic. Compounding doesn't only work for investments, it works against cash. That's the irony. People spend years learning compound interest. Very few learn compound inflation. One builds wealth, the other quietly erodes idle money, and the two are constantly racing each other. This creates an unusual financial reality. Doing nothing isn't neutral. Keeping large amounts of cash under a mattress doesn't preserve wealth. It slowly converts purchasing power into history. Now think about incentives. Imagine you're a government carrying enormous debt. Inflation changes the math. If wages and tax revenues gradually rise alongside prices, old debts become easier to manage relative to the size of the economy. The numbers on the loan remain the same, but the money used to repay it is worth a little less. Imagine borrowing $100,000 20 years ago. Back then, it represented years of average income. Today, because incomes and prices have generally risen over time, repaying that fixed amount often feels less overwhelming than it originally did. Inflation quietly changes the real burden of fixed debts. Borrowers often benefit. Lenders often don't. Cash savers certainly don't. This doesn't mean governments intentionally create inflation simply to erase debt. Reality is more complicated. Economic stability, employment, financial crises, and countless other factors influence monetary policy. But inflation undeniably reshapes who gains and who loses, and that's where incentives become fascinating. Consider 3 people. One stores cash, one owns businesses, one owns productive assets like stocks or real estate. Inflation arrives, the cash holder watches purchasing power shrink. The business owner may gradually raise prices. The asset owner often sees the underlying value of productive assets adjust over time, although not always smoothly and not without risk. The same economic force produces 3 different outcomes. That's why wealthy households often think differently about money. They don't simply accumulate currency. They accumulate ownership. Ownership of companies, land, factories, technology, infrastructure, intellectual property, things capable of producing future value. Cash becomes temporary. Assets become long-term. This distinction changes everything. Now, let's address a common misconception. People often say, "My salary increased, so I'm doing better." Maybe, maybe not. Suppose your salary rises 5%. Sounds excellent. But if prices rose 6% during the same period, your purchasing power actually declined. You're earning more, but affording less. Economists call this real income. not the number on your paycheck, what that paycheck can actually buy. Nominal wealth feels satisfying. Real wealth determines your lifestyle. That's an important difference because humans naturally anchor themselves to visible numbers. A higher salary, a larger bank balance, a rising home value. But purchasing power doesn't care about appearances. It only cares about what those numbers translate into in the real world. Here's another subtle consequence. Inflation doesn't affect everyone equally. Retirees living on fixed incomes experience it differently than young professionals receiving regular raises. Renters experience it differently than homeowners with fixed-rate mortgages. Urban households experience it differently than rural ones. High-income families experience it differently than low-income families. The invisible tax isn't evenly distributed. Some barely notice it. Others feel it every week at the grocery store. That's one reason inflation becomes politically explosive. Everyone experiences the same headline. Very few experience the same reality. Now, consider your savings account. Years ago, banks often paid interest that meaningfully offset inflation. Sometimes they still do. Sometimes they don't. When your savings earn less than inflation, your account balance rises while your purchasing power falls. That feels almost designed to confuse people. The statement says you're richer. Reality quietly disagrees. This is why investors obsess over something called the real rate of return, not simply how much an investment gained, how much it gained after accounting for inflation. A 10% return during 8% inflation isn't really 10% in terms of purchasing power. The difference matters because life is purchased with purchasing power, not percentages, not account balances, not headlines, actual goods, actual services, actual time. There's another layer that rarely enters everyday conversation. Expectations. If businesses expect inflation, they adjust prices. Workers negotiate higher wages. Suppliers demand higher contracts. Investors change portfolios. Consumers accelerate purchases before future increases. Expectations themselves begin influencing inflation. It's remarkably psychological. The belief that prices will rise can help prices rise, which makes managing inflation one of the most delicate balancing acts in economics. Move too slowly. Inflation can become persistent. Move too aggressively. Economic growth can stall. Employment may weaken. Financial markets may react violently. There are no perfect choices, only trade-offs, and every trade-off creates winners and losers. So where does this leave ordinary people? Not with panic, not with conspiracy theories, not with magical investment promises, simply with a clearer understanding of the game. Money, sitting still slowly, changes character. Inflation is part of the environment, much like gravity is part of physics. Ignoring it doesn't make it disappear. Understanding it changes how you interpret almost every financial decision. Suddenly, the question isn't just, how much money do I have? It's, what will this money actually buy in 10 years? Those are entirely different questions. History offers one final lesson. Currencies have changed. Governments have changed. Economic systems have changed. Technology has transformed entire civilizations. Yet one pattern appears again and again. Money is never merely paper or digital numbers. It's a claim on real resources. Food, housing, energy, labor, innovation, time. When the value of that claim quietly changes, society changes with it. Some people adapt almost automatically. Others spend years wondering why running faster never seems to move them further ahead. Perhaps the invisible tax isn't invisible because it's hidden. Perhaps it's invisible because we've mistaken familiar for normal. Every year, prices change. Every year, purchasing power shifts. Every year, millions of people focus on how many dollars they own instead of what those dollars actually represent. And maybe that's the most expensive misunderstanding of all. The next time someone tells you they've made more money this year than ever before, there's only one question worth asking. After everything became more expensive, did they actually become richer?